Good evening, everyone. Tonight's lecture, the final lecture of this series for Business Ethics, Decision Making, Personal Integrity, and Social Responsibility by Laura P. Hartman, Joseph Desjardins, and Chris McDonald, Chapter 10, Ethical Decision Making, Corporate Governance, Accounting, and Finance. Chapter 1, Objectives. After reading this chapter, you'll be able to explain the role of accountants and other professionals as gatekeepers, describe how conflicts of interest can arise for business professionals, outline the requirements of the Sarbanes-Oxley Act, describe CASO framework, define the control environment and the means by which ethics and culture can impact that environment, discuss the legal obligations of a member of a board of directors, explain the ethical obligations of a member of board of directors, highlight conflicts of interest in financial markets and discuss the ways in which they may be alleviated, describe conflicts of interest in governance created by excessive executive compensation, and define insider trading and evaluate its potential for unethical behavior. A quote by Warren Buffett: "Earnings can be pliable as putty when a charlatan heads the company reporting them." Very, very well said. Introduction. The scandals of the early 2000s involved fundamental questions of corporate governance and responsibility. There was a rash of problems associated with the financial meltdown in 2007, 2008. I lived through those. A lot of friends lost jobs. People lost their businesses. Terrible, terrible time to be alive. Ethics in the governance and financial arenas is now the most visible issues in business ethics. Analysts contend that corruption is evidence of a complete failure in corporate governance structures, the structures by which corporations are managed, directed, and controlled toward the objectives of fairness, accountability, and transparency. The structure generally will determine the relationship between the board of directors, the shareholders or owners of the firm, and the firm's executives or management. Professional duties, conflict of interest. Next slide. The Enron Corporation, and the word Enron, the name Enron will be synonymous with being crooked, with being unfair, uncaring, selfish. So again, the Enron Corporation brought the ethics of finance to prominence at the start of the 21st century. Let's define the term gatekeeper. Gatekeepers act as watchdogs to ensure that those in the marketplace play by the rules and the market functions as it should. There are several important professions, for example, attorneys, auditors, accountants, and financial analysts. Role identities determine ethical duties and provide a source for rules which determine how professionals ought to act. Next slide. Continuation of professional duties and conflict of interest. The most basic ethical business issue facing gatekeepers involves a conflict of interest. This exists when a person holds a position of trust requiring they exercise judgment on behalf of others, but where their personal interest and or obligations conflict with those of others. Conflicts can arise when a person's ethical obligations in their professional duties clash with personal interests. Such professionals are said to have fiduciary duties, a legal duty to act on behalf of or in the interests of another to their clients. Figure 10.1 illustrates conflict of interest in public CPA activity. Please see Figure 10.1 for yourselves in the slides. Professional duties and conflict of interest, continuation. Because gatekeeper duties are necessary for fair and effective economic markets, gatekeeper duties should trump responsibilities to their employer. But knowing one's duties and fulfilling those duties are two separate issues. The gatekeeper function is necessary, but self-interest can make it difficult to fulfill these gatekeeper duties. Society has a responsibility to create institutions and structures that will minimize these conflicts. Critics say government regulatory rules alone will not avert crisis. That conflicts within the accounting and financial industries created an environment where watchdogs have little ability to prevent harm. The Sarbanes-Oxley Act of 2002. A string of corporate scandals shook investor confidence. Congress passed the Public Accounting Reform and Investor Protection Act of 2002, commonly known as the Sarbanes-Oxley Act, which is enforced by the Securities and Exchange Commission, affectionately known as the SEC. Applies to more than 15,000 publicly held companies in the U.S. The European Union 8th Directive covers many of the same issues. Some states issue similar legislation applying to private firms. No regulatory fix is perfect. The act is intended to provide oversight where none existed. Oversight in terms of accountability and responsibility. Continuation of the Sarbanes-Oxley Act of 2002. The following sections impact corporate governance and boards. Section 201, services outside the scope of auditors, no consulting. Section 301, auditors and boards need independence. Section 307, rules of professional responsibility for attorneys. Section 404, management assessment of internal controls. Section 406, required codes of ethics for senior financial officers. Section 407, disclosure of audit committee financial expert. Requires that they actually have an expert. The internal control environment. Internal control mechanisms are established internally to comply with financial reporting laws and regulations. One way to ensure controls is to utilize a framework by the Committee of Sponsoring Organizations known as COSO, a voluntary group of audit and accounting organizations seeking to improve reporting through a combination of controls and governance standards called the Internal Control Integrated Framework. Much of this is covered in auditing courses, which is outside the scope of our course. The elements comprising control structure are control environment, the tone or culture of a firm, risk assessment, control activities, information and communications, and ongoing monitoring. The internal control environment. COSO standards moved audit compliance and governance from a numbers orientation to concerns for the organizational environment. Both internal factors such as the COSO controls and the external factors such as the Sarbanes-Oxley requirements must be supported by a culture of accountability. COSO developed a new system, Enterprise Risk Management Integrated Framework, to evaluate and improve a firm's prevention, detection, and management of risk. Expands on the prior framework to include objective setting. Assist in resolving ethical dilemmas based on a firm's mission, culture, and tolerance for risk. Ethical decision-making. A quote by Peter Drucker. Whenever an institution malfunctions, as consistently as boards of directors have in nearly every major fiasco of the last 40 or 50 years, it is futile to blame men. It is the institution that malfunctions. Going beyond the law, the ethical board member or ethical board members. The corporate failures of recent years would suggest a failure on the part of corporate boards as well as a failure of government to impose high expectations and accountability. In many cases, boards and executives operated within the law. Some actions may not have been ethical or in the best interest of stakeholders, but they were legal. The law offers some guidance on minimum standards for board member behavior, but is the law enough? Legal duties of board members. U.S. law imposes 3 clear duties on board members. The duty of care is the exercise of reasonable care, ensuring that executives carry out responsibilities and comply with the law. The duty of good faith is one of obedience, requiring faithfulness to the organization's mission. The duty of loyalty requires faithful board members give undivided allegiance when making decisions affecting the organization. Conflicts of interest are always to be resolved in favor of the organization. The federal sentencing guidelines suggest the board exercise reasonable oversight of the ethics compliance program by ensuring it has resources, has levels of authority, and direct access to the board. Beyond the law, there is ethics. Whom does the board represent? Who are its primary stakeholders? If the board is aware of an unethical but legal practice, on what basis can the board require the practice to cease? Some suggest boards have a responsibility to explore and investigate the organizations they represent. What could drag the firm down and what could competitors do to help it along that path? It is the board member's ultimate duty to provide oversight, which is impossible without knowing the answers to these questions. Ethical decision-making. A quote by Greg Smith, former Goldman Sachs executive director. It astounds me how little senior management gets a basic truth. If clients don't trust you, they will eventually stop doing business with you. It doesn't matter how smart you are. How true it is. Conflicts in accounting and the financial markets. Conflicts of interest extend beyond the boardroom to the financial arena. Trust is an integral issue in the finance industry. Real or perceived conflicts can erode trust and often exist as a result of varying interests of stakeholders. CPAs are governed by many rules and guidelines. The American Institution of CPAs publishes professional rules. GAAP, or Generally Accepted Accounting Principles, established by the Financial Accounting Standards Board, stipulates methods of gathering and reporting information. Accountants are also governed by the American Institute of Certified Public Accountants Code of Professional Conduct. Can these keep pace with readily changing accounting and financing activities in newly emerging firms? Executive compensation. Few areas of corporate governance and finance have received as much public scrutiny as executive compensation. In 1960, the average CEO pay was 12 times the average worker pay. By 1974, CEO pay was 35 times the average worker's pay. By 2000, it had risen to a high of 525 times the average worker pay. Even after a decline, the ratio remained high in 2011, at 380 times higher than the average employee worker's pay. Skyrocketing executive compensation packages raise numerous ethical questions. Greed and avarice are descriptive terms. Fundamental questions of distributive justice and fairness arise. Continuation of executive compensation. Serious ethical challenges arise against these practices, even from within the business perspective. Beyond issues of personal morality and economic fairness, excessive compensation raises ethical issues of corporate governance and finance. In theory, compensation packages serve interests in two ways. They provide an incentive for executive performance, and they serve as rewards for accomplishments. In practice, reasonable doubts exist for both rationales. In many cases, there is no correlation between compensation and performance. There is a diminishing rate of return on incentives beyond a certain level. Continuation of executive compensation. Another crucial governance issue is the disincentives that compensation packages and stock options provide. Executives have incentive to focus on short-term stock price rather than long-term corporate interests. Stock options may be to blame for the corruption involving managed earnings. Excessive compensation can also involve a variety of conflicts of interest and cronyism. Another large concern is the cross-fertilization of boards. Figure 10.2 talks about duties of the board and senior executives that may give rise to conflict of interest. The board. Duties of boards are ensure executives are fairly and not excessively paid, evaluate the executive's performance. Senior executives. Duties of senior executives. CEO often serves as chair of the board of directors, so that's a problem. Often hand selects members of the board of directors, so that's self-serving. Compensation received by board members is determined by the chief executive officer. So, who's in charge? Insider trading. Trading of securities by those who hold private inside information that would materially impact the value of the stock and then allows them to benefit from buying or selling the stock. Illegal inside trading also occurs when corporate insiders provide tips to family members, friends, etc. Private information includes privileged information not yet public. Patently unfair and unethical as it precludes fair pricing based on equal access of information. Is there sufficient deterrent to discourage insider trading in our markets today? Figure 10.1, the client's board of directors works directly with the client and has a possible conflict with the client's management team. The client works with their own management team, and the management team hires a CPA firm and works with it daily. The client pays the CPA firm and has a vested interest in the CPA's report to the public. The client has a financial obligation to the CPA firm, and the CPA firm has a contractual obligation to the client. The CPA firm has a fiduciary and ethical obligation to the public to truthfully report the client's accounting information. This is a summary of Figure 10.1. Thank you and have a wonderful day, and thank you for taking business ethics. Have a great career, and I wish you all the best.